Welcome back, everyone. Today we are diving deep into the geometry of the markets. Have you ever looked at a massive price rally and wondered, how much higher can this actually go? Or watched a stock crash and asked, where's the floor? Most traders guess. They use gut feelings. But professional technical analysts use measured move patterns. Specifically, we are going to master swing targets, flags, and pennants. These aren't just shapes on a chart. They are visual representations of market psychology, periods of intense energy followed by a brief rest before the next explosive move. By the end of this video, you will know how to calculate precise price targets using the Flagpole method, how to blend Western chart patterns with Japanese candlesticks, and how to spot the difference between a minor pause and a total trend reversal. Before we look at the specific patterns, we need to understand that every swing target, flag, or pennant is comprised of three distinct segments. If one is missing, the pattern is invalid. The impulse move, this is a cleanly defined, brisk move. It represents high conviction from buyers or sellers. The correction, this is the breather. The market becomes overbought or oversold and needs to consolidate. The resumption, this is the measured leg, where the market continues in the same direction as the initial move. Let's look at swing targets first. The theory here is simple. If the market advances vigorously and then retraces, the next leg of the move should be at least equal to the height of the previous channel. Imagine a rally from point A to point B. That is your initial move. Then, the market pulls back to point C. To find your swing target, you take the vertical distance of A to B and swing it or project it, starting from the low at point C. This gives you a mathematical objective for where the next wave should end. Swing targets are very similar to flags and pennants, but there is a key difference: magnitude. In a swing target, the correction, point C, is usually substantial, often a 50% or 61.8% Fibonacci retracement. Flags and pennants, however, are shorter-term congestion bands. Think of them as a pause that refreshes. They serve to relieve an overbought or oversold condition quickly without the price collapsing. The flag. A flag is a horizontal or slightly slanted box range. It looks like a rectangle flying off a pole. This tells us the market is moving sideways as buyers and sellers battle it out in a tight corridor. The pennant. A pennant looks like a small symmetrical triangle. It has lower highs and higher lows, meaning the range is narrowing or coiling like a spring. This coiling action usually leads to a more violent breakout because the energy is being compressed. Calculating the target, the Flagpole method. In both cases, we use the height of the initial move, which we nicknamed the flagpole. Now, there is a debate in the trading world. Where do you start the measurement? Traditionalists add the flagpole height to the top of the flag. However, I prefer a more conservative approach. I add the height of the flagpole to the bottom of the congestion band, point C. Why? Because I'd rather exit the trade a few ticks early and lock in profits than wait for the absolute peak and risk a sudden reversal. In trading, leaving the last 10% for the next guy is a strategy for long-term survival. It works exactly the same in reverse for short sellers. For a bear flag, you take the vertical drop, the flagpole, and subtract that range from the top of the consolidation band. Let's look at a real-world example. Imagine a stock in a vertical rally, moving from $10 to $20. That $10 move is our flagpole. The stock then declines to $16.18. If you're a fan of Fibonacci, you'll recognize that as an almost exact 61.8% golden ratio correction. Once the stock starts to advance again from that $16.18 level, point A, we calculate our swing target. We take our $10 flagpole and add it to $16.18, giving us a target of $26.18. Pro tip: always look for confluence. If your projected swing target lands exactly where a bearish engulfing candle pattern appears, you have a high probability signal to exit your longs and perhaps even consider a short position. This is where Western technicals meet Eastern philosophy. Let's look at an example where a stock rises from A to B and then takes a breather for a week. If a rising window, a gap up, opens after this consolidation, it does two vital things. 1. It confirms the trend is shifting north again. 2. The window itself becomes a floor or potential support. While the window gives us a bullish bias, it doesn't give us a price target. For that, we go back to our bull flag calculation. By adding the flagpole height to the bottom of the flag, we get our objective. Watch what happens when the price hits that target. If you see a shooting star or an evening star pattern right at your calculated resistance, the market is screaming at you that the move is over. If the price later fails to close above the real body of the evening star, the resistance is confirmed. Remember, I always look at resistance based on the closing price. Intraday spikes above resistance are common, but if the bears can push the price back down before the closing bell, the resistance remains intact. Let's look at a steeper decline. A sharp drop from A to B creates a long flagpole. Then, the market moves into a narrow, triangular range, points B and C. This is your bear pennant. Once the bottom of that pennant breaks, the trapdoor opens. You subtract the AB flagpole from the minor high at point C to find your downside target. Often, these moves will exceed the target. So, how do you know when to cover your short? Look for a piercing pattern at the bottom. Even if it's a variation, meaning the white candle doesn't cross the 50% mark of the previous black candle. If it's the first white candle and the first higher close in the entire decline, treat it with respect. If the market successfully defends that support the following week, your bearish thesis is officially dead. Finally, let's talk about the big brothers of the pennant, triangles. The ascending triangle. This pattern has a flat top, horizontal resistance, and a rising bottom, higher lows. This shows that while sellers are parked at a certain price, buyers are getting more aggressive on every dip. They aren't waiting for lower prices anymore. Target. Measure the height of the widest part of the triangle and add it to the breakout point. The descending triangle. The opposite is true here. You have a flat bottom, horizontal support, and a falling top, lower highs. The bears are keeping the bulls in check, and the pressure is building against that support floor. The change of polarity. This is a crucial concept. Once the support of a descending triangle is broken, it often flips to become new resistance. If you see a falling window, gap down, immediately after the support break, you have a convergence of factors. You have the broken triangle support and the gap, both acting as a ceiling. This is an incredibly strong signal that any rallies should be sold. Trading is not about being right 100% of the time. It's about having a map. The flagpole gives you the length of the journey. The flag or pennant tells you when the market is pausing to refuel. The candlestick patterns, like shooting stars or piercing patterns, act as the traffic lights, telling you when to stop or go. Combine these Western measurement techniques with the visual power of Japanese candlesticks, and you will have a significant edge over the retail crowd. If you found this breakdown helpful, hit that like button and subscribe. In our next video, we'll be discussing how to use these patterns on 5-minute charts for day trading. Until then, keep your charts clean and your stops tight. Happy trading!